If you're tuning in tonight, it's because you either have, I'm guessing, tried to use Fibonacci before and just did not have a lot of luck with it, or you're completely new to Fibonacci and you're curious what this funny sounding indicator or study or calculation is all about, and we'll clarify exactly what it is in a moment. Or you're using Fibonacci with some success and you're just curious as to how I'm doing it. Whatever the case may be. What I'm going to show you tonight is just another way of identifying support and resistance. So everything else aside, as far as the calculations and the subjectivity and everything else that involves Fibonacci, what I want you to remember is that this is really about just another way of identifying support and resistance. That's what I'm talking about here today. And really, without overcomplicating and certainly without trying to oversimplify, let's discuss what it is that we are looking at when we are looking for any kind of support and resistance, not just Fibonacci. So support and resistance is just another way of finding what I call decision levels. Those levels at which we expect price action to react. We expect either a stall, an acceleration, or a reversal. Now, this is the summary of literally my 2 decades of trading. Isn't that kind of sad? I can summarize my 2 decades of trading. No, actually it's very powerful. Here's why. A lot of people are looking for multiple distinctions, multiple reasons, multiple things that they've learned throughout the years. And for me, I can actually boil it down to the fact that everything I'm trying to do is looking at a chart like this one of the daily chart of the Euro US dollar and trying to find those points or areas in front of me that are most likely to be reacted to. And I'm proud to say that I could boil it down to that one statement because that clarifies, absolutely gives me a tremendous amount of focus into what it is that I'm doing when I get up and sit in front of my many, many monitors every day that are probably irradiating my brain beyond recognition. So, when I am sitting here telling you that everything is about support and resistance, I truly believe that. But it's not just support and resistance, it's about finding those levels that are most likely to be reacted to and therefore are decision levels. And I kind of would love for you to start thinking about support and resistance or any line that you draw on your chart, whether it be a horizontal floor or ceiling or whether it be an up or downtrend line. I would love for you to start thinking about this word, decision level. It's not just semantics. It's not just a word play. It's really about what it is you're looking for. It defines and will focus you to absolutely be clear about why it is you're drawing that line or level. Because if you don't really expect prices to have some sort of reaction at that line or level, as far as I'm concerned, it shouldn't even be on your chart. It should not even be a distraction. So we always want to keep in mind that everything we're looking for is about decision levels. So to come kind of full circle here, Fibonacci is just another way of calculating or identifying or discovering these decision levels. What makes Fibonacci different from anything else and why do I believe in it? Well, here's my take on Fibonacci, and here's why I think it's not just a trading indicator, because it never really was a trading indicator. It really is a mathematical law of nature. And if you'll kind of hang with me for a second, I'm not going to get all touchy-feely zen with you or anything, but the truth of the matter is, when we're trading any kind of market, stocks, forex, futures, the bottom line is we are really measuring, gauging, anticipating human reaction. That's it. And humans, as far as I remember, we are part of nature, right? So it's the nature of the market. It's the psychology of the market that we're actually measuring. And this absolutely gelled for me when I started reading about Charles Dow and Dow theory. For those of you that are familiar with what I do, you know that I was really influenced by what Charles Dow said and wrote regarding the markets. Now, he wrote about the stock market, and that's fine. So there's a certain bullish bias to what he's discussing, but the psychology that he discussed behind the market trends, behind mark up and mark down, more commonly known as an uptrend and downtrend, behind accumulation and distribution, which are respectively a narrow sideways trading range and a more volatile sideways trading range, everything boiled down to the psychology that the market was reflecting. So I look at the market as fearful, that's a downtrend; greedy, that's an uptrend; confused, that's typically distribution; and finally bored or anticipatory, expecting something, and that would be accumulation. So if I know what the market is reflecting in terms of psychology, and I'm absolutely going to use price to do that, I don't think it's a big stretch, therefore, to say that everything I just discussed with you just for the last minute there or two was about psychology, about the nature, about human nature, and how that's reflected in these things we call candlesticks or bar charts or a line chart or however we want to call it. Whatever type of charting is out there. I know there's a million different types of charts out there, but however it is that you decide to plot your price action. Okay, you see I use candlesticks and actually in particular grab candles. Everything is a reflection of that fear, greed, confusion, boredom, anticipation, psychology. Therefore, if you're with me so far, if you can buy into what I've said so far, then the next step is, can we then use a tested and proven mathematical approach to measuring nature, in this case the nature of the markets, and that's Fibonacci. So don't let anybody tell you otherwise. It's Fibonacci, or I should say the retracements and extensions and the number and the series, is actually applicable to biology and chemistry. And if you look at specifics, I'm sure a lot of you are familiar with the nautilus shell example, or some of you might have heard about the bumps on the pineapple, the way they actually form on the outside of a pineapple, the way a tree, the branches will grow, the way, if I recall, the way cells will split. Those all can be explained by this Fibonacci formula. So again, it's not just a trading indicator. Again, my belief in my trust in it comes from the fact that it is a mathematical law of nature, and the markets are a reflection of our nature. So that's the touchy-feely part. It's done. How do we apply it to the markets? Let's start looking at some concrete examples, starting with this Euro-US dollar daily chart. Where the heck could it exhaust in the correction and transition? We're going to talk about both, and let's go ahead and dive into that right now. Looking at the daily chart of the Euro-US dollar, let's discuss a few things outside of Fibonacci right now. And then I'm going to get into last major move, and we'll get into what it is that we're looking for when we draw a Fibonacci retracement. And also I'll talk about these percentages that are on the horizontal support or resistance levels here. Okay, so what's happening with the Euro-US dollar right now? I know a lot of you are curious. One of the things that we have to face facts, and we can look at the last year of price action, because again, the look back for this chart would be 1 year, which would put me at January of 2011. So let's go ahead and drop that, and specifically January 26th. So that's a 1 year look back right there, where I've dropped that that vertical line. Everything to the right of this line is our market memory or look back. And Fibonacci aside, anytime you're going to do any kind of analysis, it's my opinion that you've got to start with some sort of psychologically relevant amount of data. you don't make it random. Most people do. Don't make it what is comfortable for your eye, because sometimes that's too much, sometimes that's too little. The fact of the matter is, I believe that every time frame has a certain memory. I think that looking at 52-week highs and lows, looking at the gaps if you're a stock or futures trader, looking at the overall trend of the market over the past 12 months is very important, because that's where people formulate their bigger picture, larger opinion, that dominant psychology of any market. It's the daily chart. It's not a 5-minute, it's not a 30-minute, it's not a 4-hour, it's that daily. That is the one that I think the most people look at, and therefore it's the most psychologically relevant. Now hear me out, it doesn't mean it's necessarily the one you're going to trade, but it does mean it's the one that I think holds the key to what the dominant opinion is of the state of any market. So what is the dominant opinion? Looking at the last 12 months, looking at the way in which it's been trending higher, because let's not forget, in the early part of last year, the euro-US dollar was looking pretty unstoppable, wasn't it? And then most recently, we can see the move lower, a couple moves lower here, and there was a good deal of time where this market had absolutely no clue what it wanted to do. Every one of these angles, I guess you can say these, every one of these arrows, and you can see I'm a big fan of color coordination. Why? Well, green is bullish. It's in an uptrend. It's assumed that I'm going to be focusing in on higher highs, higher lows, which is really the backbone of the uptrend, the support. And it's my opinion that in these situations, when prices do pull back, it's about identifying where the support will be. Well, here's the cool thing about Fibonacci. That's what it's designed to do. Fibonacci is actually, in the context of a trend, in the context of any kind of significant rally or decline, when prices do correct, it's Fibonacci's, I guess you can say, job in many ways, to identify where the exhaustion or where that correction could exhaust or could pause. It's in decision level speak, it's that stall and reversal. So what I want to keep in mind is there was a psychology here that was bullish. There was a psychology here. This was confused, moving sideways, bearish and bearish. Mark up, distribution, mark down. You could probably call this a distribution for a shorter period of time, even though it was dominantly bullish for that short period of time. And then a resumption of the markdown. Most recently, and here's where it will get interesting, and you can already see I've got a Fibonacci drawn on this chart here. The most recent move lower from this point to this point here has begun to move up higher, obviously. And what's happened, more importantly, is that the daily chart, which was in a markdown or downtrend, has not only broken the 34 EMA wave, but we have to acknowledge the fact that when we jumped into the wave and were able to break higher through the 34 period EMA high, which is this green dashed line here, we actually shifted from what was a downtrend, and I'm not going to say it's an uptrend yet. Okay, don't make the mistake of saying just because a downtrend is broken, it is now an uptrend. I would not make that leap quite yet. Certainly for those of you that are looking at just trend lines, there's a number of trend lines you could have drawn, and we've just about broken any significant one on this move higher. What's happened is we've now gone into what I think could be a sideways range. Now, typically my expectation for any kind of break of a trend is going back to that traditional Charles Dow approach, which is typically we move from trend to some sort of sideways market, whether that be distribution or accumulation, whether that be that wide volatile range, which is what I think we're going to have here, or whether it be a more narrow sideways volatile range. By the way, we've done this before. Let me show you examples of this. We had this uptrend that was in place, right? I think in a big picture, we probably could have said that we formed a triangle at some point here, regardless of what you wanted to connect as far as trend lines go. Okay, so there's a triangle in this area. There are all the resistance levels there, number of support levels we could have drawn. I mean, there's a lot of different lines and levels I could have drawn here. Just the touch points are really fairly endless here, you know. I think the resistance levels are probably easier to define than the support. But I think it's pretty easy to say that we started to congest. If nothing else, I think we could all agree that this market basically found a range and stayed within it for the most part, with the exception here, but for the most part it just chopped around in a range, and that volatility is really a hallmark of distribution. So now that we have what has become a reversal, the question in everybody's mind, and the question that you have to ask yourself is, what am I looking for? Because before I just pull Fibonacci out of my trader's toolbox, I want to know what the heck I'm looking for. You know, every tool has a particular job. Fibonacci is no exception. When I look at what it is that I'm focusing in on here, I may not necessarily trade this daily time frame, but I sure as heck would like to know where possibly the selling pressure could come in. And that would make identifying potential levels of resistance really helpful. So not only could Fibonacci identify those potential levels of resistance, but on the way back down, these lines and levels could absolutely be levels of support. What was once resistance becomes support. So if there was some sort of recognition on the way up, there's a pretty good likelihood that there might be some recognition on the way down. So it makes sense. It's the old, what was once support could become resistance. Simple as that. Okay. So why and how did I draw this particular Fibonacci that you see here in front of you? And let's get a little bit more basic. How do you put these particular levels with the price, which is really nice, on your charts? So what I'm going to do here is go into Fibbo properties, and we'll start off with this view here. So you'll notice that I've added a lot of, for those of you that are opening your default setting, chances are it's a yellow color or maybe a red. I make mine black. And notice I do use white charts, so whatever chart color you use, just make sure the background color and whatever you choose here for your labels has enough contrast. So notice I'll use a number of levels here, 23.6, 38.2. The level in terms of the first column here, that's the actual calculation. And by the way, what is this calculation? This is a percentage of the overall move. So if I've basically identified that there is a move that's carried prices from this high here to this low down here. And you know what? Let me go ahead and put this in a color that everybody can actually see. So I want to go ahead and look at that high there to this low down there. So this is the move, and it is what? It's a sell-off, right? It's a decline. The last major move, the last meaning most recent, major meaning significant, and move meaning rally or sell-off. Last major move, most significant, or I should say recent, most significant sell-off or rally was this move right here. Now, there is no such thing as the only last major move. Some people might say, well, Raghee, what about some of these other highs that are in place? What about this high back here? What about, what about this one right there? What about this one? So obviously I'm not, this is where the subjectivity comes in and can make people extremely confused, because the bottom line is there are a number of sell-offs and rallies in just this particular area of the chart. And I might look back 1 year, right? But I want to look at the most recent significant sell-off or decline. Therein lies probably the first and probably the most major hurdle in people using Fibonacci with any kind of regularity and confidence. I would recommend drawing a lot of different last major moves, because a lot of times what you'll find is that previous support and resistance will line up with some of the Fibonacci levels. And when I see that I'm dealing with a situation where previous highs and lows might be lining up. For example, I drew this line after this low. I drew this Fibonacci after this low was put in here. And as soon as I drew it, the 618 and this high back here lined up. As soon as I drew it, the 50% had lined up with, I know this is getting a little messy, but what I want you to notice is, as soon as this was put in place, there were a number of levels that became very obvious in terms of their relevance, we can say, to the Fibonacci. And again, this area here popped out, this area here popped out, this area here. So there were a number of previous price levels that lined up with some of these Fibonacci's. That's one way of having a visual confirmation that you've got what I would consider the most right or the most applicable Fibonacci retracement. Getting back to the levels that I look at, the first column is the actual calculation. So I mentioned this move, right? The two circles that I had drawn from this high here to this low. This is 23.6% of that move. Okay, so if I were to simplify that move and just turn it into a straight line, let's make it really easy to see. Okay, just like that, boom. This level is 23.6% of this move. This level here is 38.2% of this move. This is the halfway mark. This is the golden mean of the 61.8. This is 78.6% of that move. Here's 88.6%. And here is 100%. It's been a full retracement. It came back from where it started. Full retracement, 100%. So each one of these represents a percentage of the market climbing back from where it came from. In this case, it's a climb back. Sometimes it could be, in the case of a last major move that's a rally, it could be selling back off from where it came from. We'll talk about that also in a moment. So in terms of where I think prices could exhaust now, not only do we have a previous high back here, but it's also lining up with the 61.8. It's also, by the way, lining up not too far from the 38.2%. I'm sorry, the 3,200, 38.2. I'm making overlapping here my numbers. So let me say that again. Not only was it a previous high, it's also the 61.8, and it's also just a handful of pips away from the 3,200 major psychological level. You think there's going to be a lot of people maybe waiting here to sell this particular area off? In fact, the area that I was watching for resistance was a 150 pip area. But what I want to point out is, for those of you that look at average pip movement ranges, the average pip movement range for the Euro US dollar from Monday through Thursday is approximately 150 pips. That's a daily trading range. So I was looking at 3050, 1.3050 to 3200 area of potential resistance. In fact, I wrote about it over at the dailyforextradingedge.com. This area that I'm expecting. Why is that so important to me? Because I feel now that this market is no longer in a downtrend, and using Fibonacci, I can identify where the potential resistance might be coming in, that we're going to transition into what is likely to be, and this is going to be fairly maddening for us from here on out, it's likely to be this kind of chop in this area going forward. I don't know what the range is going to be to the downside, but we know the floor could be as low as this area, and it's possible that that 3200 level is going to be the ceiling. So we could be chopping around in that very wide area. Fibonacci helped me narrow down which one of the many, many, many price levels we could be dealing with. I mean, I obviously am looking at the psychological levels, but Fibonacci helped narrow down which one of these levels could be the decision level that eventually becomes a ceiling. Make sense? Okay, I keep mentioning that I'm going to show you how to do this. Let's go ahead and do this real quick before I move on. So you can see the different percentage levels here, and they're going to coordinate with what you see here on the level, which is the actual calculation, and the description. Now notice that, and let me get up to past the 1.0. The difference between retracements and extensions, anything beyond a 100% move is an extension. It extends beyond a full retracement, full meaning 100%. So this is 127% of this move. So this move here was quite simply, oh, that's not what I wanted to do. This move here was a sell-off, right? This was 100%. This is 127% of this move. So it goes beyond the 100%, and it adds another 27.2%. So this is this move plus 27.2%. The 168.8, that is this entire move plus 61.8%. So the extensions, which are anything beyond the 100%, actually are the levels that, if we don't have another last major move, for example, if prices, for whatever reason, continue to climb and they exceed the 100% and we're still in search of potential resistance levels, these extension levels will then come into play. So I don't draw a separate extension. I just make them part of my Fibonacci retracement. And by the way, 0 to 100% are my retracement levels. Why? Because they're retracing the steps, basically, that they made from this, in this case, the sell-off. And again, the extensions are beyond 100%. So once you get to the 100%, you do 1 point, whatever that is. So even though this shows 161.8, this calculation is actually this here. Okay? Now, as far as the description goes, the big thing that you want to keep in mind is this at percentage $ formula after you put in the description of the Fibonacci percentage. So, for example, the 50%, 50.0 to show me 50%. You can see the calculation here is 0.5. Then I do at percentage $, and that's what gives me this price here. Because quite frankly, having the Fibonacci levels there without the price listed, to me is just, it's giving myself one more extra step to have to deal with. I'd rather have it plotted right in front of me for ease of use, because essentially that is a level that I'm going to be watching for potentially what? As a reaction, as a decision level, right? These are all potential resistance levels on the way up. And by the way, when I draw a last major move that is a downtrend, when I draw a Fibonacci retracement from a move lower, like we have here, what I want to remember is that I'm projecting, and that's the word we have to use. We're projecting potential resistance levels. That's what Fibonacci is going to offer. So you have to ask yourself, what am I looking for? Am I looking for support? Am I looking for resistance? In the context of a downtrend reversal, our question is, where could prices be met with selling pressure? Where is the potential resistance? Where are the sellers potentially perched at? And that is attempted to be answered by drawing a Fibonacci retracement from a last major move, which is a downtrend. Doing that will then project, use that word project, okay, that's all that it's doing. It's projecting potential resistance based upon the calculation of this high to this low. That's it, okay? Please don't complicate it any more than that. Again, all it's doing is projecting the resistance levels that we could be dealing with. We don't know what they are, but they're calculated from this high to this low. That's what we're using as the calculation. If you want to put it in different terms, think about it when you're talking about a pivot. If I'm calculating a pivot, what's the calculation? It's some sort of high-low close divided by 3, right? To get my pivot point, that's the calculation. For Fibonacci, it's the movement from this high to this low, and the percentage of that move, again, 23% of that move, 38.2% of that move, 88.6% of this move, that's what's used to create the resistance levels. That's the calculation. So we've looked at the Euro-US dollar, yeah, so that was a downtrend, and I'd really like to switch over to an uptrend now. And I picked this example of the US dollar Swiss franc for two reasons. One, I want to do a recent Fibonacci, but I also want to go back in time because this example actually shows why it can be so difficult to do Fibonacci sometimes. And we're going to draw a bunch of Fibonacci's, and I'm going to show you some of the nuances and also show you an example in the context of an uptrend, okay? So let's go ahead and grab our Fibonacci tool, and at this point in time, okay, we're looking at basically up to about, I'd actually like to go to about here. This is going to the 25th of October last year. At this moment in time, prices had moved up after a fairly long downtrend. So what I want to do now is talk about where we would have drawn our Fibonacci based on the downtrend and then adjust to the uptrend, okay? Because at some point you have to make adjustments. So there's a pretty good chance that at this point in time, at some point in time, let's call it, I'm trying to imagine when you would have said, all right, enough of this particular uptrend. Realize that this Fibonacci move from the high to low, and what I'm going to do is I'll paint this one red, and that way we know that this was a move lower. You can see that right there. So this move here, as prices started to climb upwards, you can see nailed the 50%, stalled at the 61.8 for some time, stalled at the 78.6, and just shot up through the 886, through the 100 full retracement. Okay, you can see, let me make sure I might hit, there we go, shot up through the full retracement and then hit the 127.2, 127, so this is the first extension, right? Just shot up and continued higher. At some point you might want to say, well, where is the chance that prices will start moving lower? Well, the only time that I'm interested in no longer using this move here, this sell-off, the only time that I'm interested in that is when I see that the uptrend could potentially be exhausting. And that's tough because there's a number of times I might have thought to do that. Let's talk about that for a second. So this particular Fibonacci retracement based upon a move lower. At some point you might have said, maybe it's done, maybe it was done back here. Maybe you might have said to yourself, at this high right there, you might have said, you know what, maybe I want to consider the fact that this may no longer be the relevant Fibo, and that's cool. So let's go ahead and adjust. So what we would have done at that time is taken the low, gone up to this high right there, and said to ourselves, all right, where could the support be? 23.6, perhaps. There was previous resistance there. And if not, there's a 38.2. And it looks like we stopped just shy of the 38.2. Even though we pierced it once, we reversed just shy of it. But it did help us identify an area, right? And we also had the 7,800 major psychological level mixed up in there as well. So, there was a number of reasons to consider at some point this area. So there's the 7,800. And let me redraw that Fibo. Okay, so in this area, we're thinking, okay, there's a pretty good chance we're going to start to find some buying support. Major psych level, 38.2, sitting at 77.86, 77.87. Off it goes. But once it takes out our high here, this Fibo is no longer a valid Fibonacci. So some of you might say, well, we're taking off again. Maybe I'm going to go back to the previous move lower because I'm still in need of what? When we drew this Fibo right here from the move lower, it was because we were looking for what? Upside resistance. When we drew the Fibo here, what were we looking for? Downside support. So when you draw a Fibonacci based upon a decline, it is going to project resistance. When you draw a Fibonacci based upon a rally, it's going to project support. So as we look for where the next level of resistance may be, we've got to go what? To the last major move that was a decline, a sell-off, and that's going to project these resistance levels. So for a short period of time, we may have drawn a Fibo based upon this move here, looking for support, but as soon as prices took out our zero level, it was no longer valid, and we might have reverted back to the last major move that was plotting potential resistance. We could have, again, abandoned this when we made this high instead of moving down lower. Now, by the way, some of you might say, well, Raghee, why'd you pick that low versus this low? Well, let's talk about last major move again. And this is really up to you guys. This is the difficulty of subjectivity. And again, we're talking about using the support of this level versus the support of this level. Now, does the move start from here? Actually, the move went down here, yes. Kind of moved lower, and then it took off again. Would you call this low where the move started or this low? Either way, it seemed to have worked pretty nicely. You see that there? Now that's in hindsight, but these are the kind of decisions you have to make. To me, even though this low here, or even this candle base, is arguably where the move really began, either the low of this red candle or here, even though this particular wick nailed that 23.6, I'm tempted to use this low or this low because really the last major move kind of started with either the low of this red candle or this. I wouldn't call this the beginning of the rally because we actually lost more momentum. In fact, this was an odd little wick here. Even though it worked, it was kind of an odd little wick. Would I consider the momentum starting from the wick, from this red candle low, or from this green candle low? I would have to say of those three, I'd be tempted to use either the red candle low or the green candle. Even though, knowing now This wick here nailed the 23.6 much, much better, I have to say. But the bottom line is, was I ready for some sort of support in this area at 86.73? Yes, in fact, the low here was 86.46. That was the low here, 86.46. And this pointed it out at 86.73. So some of you might say, Raghee, that's terribly complicated. But you know what, I got to tell you, it's really important that you find a consistent way to find these lows. Typically, they're going to be minor lows. In other words, there's going to be a low candle that is surrounded by two higher lows. What does that look like? A low candle surrounded by two higher lows. Or a high candle surrounded by two lower highs. If that's the definition I'm going to use, and that's the definition I talked about in my first book, it's actually going to be the red candle here that I would be focusing in on. That would have to be that would be actually the minor low. All right, so it would be that red candle there, that red candle low. And at least it gave me an area. Was it perfect? No. Very shallow retracement. In fact, the 23.6 is a shallow retracement to me. But it's really important that we have this discussion, because at some point moving forward, that red candle could very well be the base of a longer term move, maybe to this high, right? You could even say to yourself, well, I could use this low here, because what is that? That's another minor low, isn't it? There's my higher low surrounding the lower low, right? It's that same kind of little mock example I had here, where it was, here's the low, and it's surrounding by the two higher lows. There's the low surrounded by the two higher lows. So that could even be a level that I would have watched, potentially. But if I'm going to redraw this, this could be another last major move, couldn't it? So moving forward, I want you to really notice that there's a number of last major moves that could be considered. Now, had we used that low moving forward, it nailed the 50%. In fact, when I drew this, notice how the 23.6 acted as support back here. Okay, some of you might be saying, well, Raghee, what about this low way down here? You know, my only problem with this is that there was a significant retracement in between. That would have been this move right there. And so the last major move really didn't start from here, because it was its own move in and of itself. I'd say it started here. Now, these 23.6% retracements, these shallow retracements, let me add another layer. And this is, I know for some of you, you're going, oh, Raghee, you've already lost me. We're 40 minutes into this and my head's already spinning. Let me give you another guideline. This particular move, from here to here, did it correct more than 23.6%? Yes. That's a significant correction. Even though it only hit the 38.2 and a little bit beyond that, it breached the 23.6. It becomes a more significant correction. 23.6 or 25% is a very shallow correction. Same can be said for this. Very shallow, hardly made it. Whether you use that low here, whether you use this red candle low we discussed. Again, very shallow. So once I've made a move, a correction greater than a 23.6, that really can't be considered an unretraced move. So this move was greater, this move lower retraced this previous move by more than 23.6. I didn't mean to draw that, sorry. So this move right here is retraced by more than 23.6%. So I really wouldn't call that an unretraced move. This retraced here, but it was shallow. Okay? So that 23.6, that shallow correction, is one that, while valid, is not substantial. In fact, it's very, very shallow. It's still a correction, but it's shallow. In fact, if I am swing trading, you've probably heard me, if you watch me swing trade using Fibonacci levels, you've probably heard me say that I'll usually not use a 23.6, that it's too shallow, that I want at least a 38.2. All right? A lot of little guidelines, a lot of little tips and tricks. Obviously, there's only so much that I can throw at you all at once, especially if you're brand new to this. But for those of you that have been doing this for a little bit of time, use that 23.6% shallow correction guideline to keep you from, say, using this low here. Okay, I don't think that's a valid high to low, using this low to say this high. Okay, bounce off the 50%. And by the way, once it went above this level here, no longer valid. Now what? Prices seem really to be gaining some steam, don't they? So what do I need? I want to know where this market might exhaust. So what could I do? I could do this. This move from this high here to this low projects potential, what? Resistance, right? Not a huge move, but if I'm looking at projecting resistance, I need a sell-off, and that's the most recent one. Okay? Some might say, well, Raghee, could we go back to that old sell-off that we had? Could we go back here? I don't really have a problem with that. We could go back here. But at some point, I exceeded even the 188. You see that? And by the way, it still worked pretty well. 127.2 did a pretty good job identifying some kind of soft support there. So you'll notice that if you draw multiple Fibos, sometimes they overlap, and those are clusters. So here we have this last major move lower, the 127.2 ceiling. Notice that it did stall at the 100%, recognizing not only the high, but a full retracement coming full circle from where it came from. And now, what are we curious about? Well, it's actually moving back down lower, isn't it? Let's take a look. Let's clean this chart up for a moment. Now, currently, what are we interested in? What's happened most recently? We've lost the support of the uptrend, with prices not only breaking the 34-period EMA low, but now they're plotting red grab candles. A lot of people are wondering, where's the floor for the dollar Swissy? And this is a pretty ugly set of candles in terms of trying to identify a last major move, because what's happened with this noise up here, it's gotten kind of ugly. But does our 23.6 rule apply? Yeah, we've made nothing more really than a 23.6 correction right there. So with that said, I could use this high, because this, even though this was kind of noisy and makes the last major move a little ugly, it doesn't invalidate my using the next high. Does that make sense? Again, it only made this little move here, only made a very slight, again, 23.6% correction right there of the last major move if we were to use it from here to here. Okay? So, with all that said, what can we be looking at right now? Prices are sitting right now in the 38.2, aren't they? Sitting right on it. Even though they pierced it, they seem to have snapped back above it. Now, I don't want to ignore the fact that the 9200 major psychological level is also in play. Let's not ignore those major psych levels. I don't want to supplant tools that I love and that I feel have a lot of psychological relevance, like psychological numbers. I want to supplement. So 38.2, 9200, that's a pretty strong level at which we could find buying support. Fibonacci substantiates it as a potential buying level, and so does the major psych level. Even though we pierced it, prices seem to have snapped back above it. And this is the Fibo that I'll use moving forward. Now, I've thrown a lot at you here in a pretty short amount of time. So what I would hope that you'll be able to do is, when this video goes online and you're able to review it, at that point, if we want to go ahead and maybe have a follow-up to this discussion, that'd be fine, no problem. I want to acknowledge this obviously is a very subjective tool. So if you're frustrated by it in the beginning, please don't give up. Just realize it's just, as we said on the onset of this discussion, another way of discovering, identifying support and resistance. Okay? And with that in mind, notice that I've also considered whether I need support or whether I need resistance projections. So that's going to keep me looking at a last major move of a sell-off versus a rally. I'm also going to consider my psychological levels. If there's past support and resistance, previous highs and lows, factor those in. Have a number of reasons why a particular level might be relevant and in play. And I really believe, because it's been my experience, and this is what happened to me, is the more you draw these levels, the more they just tend to pop out at you. Okay, when you don't draw them a lot, they become very difficult to identify. But the more you do it, the more all of a sudden it just clicks. All these guidelines aren't so conscious anymore. It just clicks. These last major moves just pop out at you. And it took some time for me too. This wasn't always easy. Back then all I was looking for were 50% corrections until I started to evolve more in my Fibonacci studies and found numerous levels in play and learned how to determine the decision levels in that regard, especially with this overlapping technique when you have a number of reasons that a particular level could be more important, like a psychological level, double zero. So, as always, thank you so much for joining me. I hope this was eye-opening. I realize this might take a couple views, so I didn't want to go too long on time, so you can go back and review it at your leisure. So again, thank you so much, and I'll see you in our next session.